We'll give it a couple more minutes until we start, probably at 3:03, 3:04. Maybe 1 or 2 more minutes and wait for more people to join. Minute and we get started. So 3:04.
While we wait, just like to tell you, Jaime, in Brazil, when people have, there you are, okay.
All right, so let's get started. First of all, thank you very much for joining the third webinar of this series. We already did how to prepare business plan in 1 hour. We did how to prepare a pitch deck in 1 hour. And today is the third one and the final one, I think, that it's about preparing specific documents. So beyond this one, we're going to cover like topics more related to finance in general and to startup finance in general. Not so much like, hands-on, but rather like knowledge sharing. But of course, hopefully like that everything is actionable for you guys and that it adds value to the community. So today is about how to prepare the startup reporting, the reporting of the startup in 1 hour. Also, like the B side of this one is how to read the startup reporting, which I think is very useful because we'll also be giving like benchmarks or the things that look good, things that look bad. So it's not only about the document itself, but we will analyze 2 cases and say like how to read them basically. So I hope this adds value to you guys. So as we have been doing in the other webinars, at the beginning, quick introduction. For some of you guys that have already like seen the others, I'll try to make it a little quicker, but just to justify more or less like why we're doing this and to see like and that we are basing our experience on many startups. So yes, then apart on, well, in this one, we're going to cover like a slightly different format that we go like at the beginning, some general comments, and then we will go to the business plan, but almost only in the Excel file. In fact, I'm not even going to follow the presentation. If you guys want to follow the presentation afterwards, please send me an email to jaime@tscfo.com Same that if you want the examples that I'm going to show of the Excel files. But I'm not going to follow the whole presentation, but if you request it, we can send it by email. And of course, try to have some time for questions at the end. But right now we are 14. So I think that if you guys have a question, feel free to write it on the chat or or raise hand in Zoom, or even like unmute and speak up. So first of all, who am I? I'm Jaime. I studied physics between Madrid and Boston. Started a PhD in biophysics, but as you can see, like I've changed a lot, like my area of expertise with time. So I was a consultant at McKinsey and Company in Madrid for about 2 years. And then is when I joined startups for the first time, 2 startups in Madrid, On Track and Juggling, having positions in finance. I was there working, and then like former colleagues and people that were starting some startups needed my help and told me, can you help us with the reporting? Can you help us with the business plan? Can you help us like with fundraising, with finance strategy, whatever? So I started having like many more projects as freelance, and at some point I decided to scale it as the Startup CFO. So what do we do at the Startup CFO? It was incorporated 3.5 years ago. And we offer fractional CFO services for startups. So again, the typical stuff that we'll be talking during these webinars. So materials, also on strategy, financial plan analysis. We participate in board of directors very often. We assess with fundraising, valuation stuff. It's many strategic topics as well, the admin and stuff like that. Startups that essentially don't need a full-time guy for the finance as a finance director use our services until they are big enough. We have worked as CFOs with over 75 early stage startups, and including other business lines that we have, like accounting or like consulting, public funding, stuff like that. We have in total worked with over 180 startups. We recently, very recently opened our first office abroad in Berlin. So we have now offices in Madrid and Berlin. And we're trying to expand our footprint there. And actually, it's been pretty successful this first month. And many VC funds already are recommending us in Germany, and our current clients in Germany are also recommending us. So, we are very excited about it. We have a YouTube channel as the Startup CFO that we have a lot of content similar to these webinars. And in particular for the webinar series, you know that you can sign up and you will receive the invites for the next 5 that are still left in this series. So why this webinar? Why do we need a webinar on reporting that is like pretty specific? The reporting should be a summary of actionable information in business terms. What does that mean? That it should be like the most important source of information, such that there's information there that the management should consume and take actions from there. Startups are based on like infinite uncertainty, essentially, at the beginning. So you need numbers to make decisions, and you need metrics, and you need to be, so you need like a report to condense all that. Must be monthly and be ready relatively quick. You shouldn't have like at the end of the month, like from the previous month, because then it's useless. You already lost 1 month in between. And a sentence that is like very important that I learned in consulting is, what is not measured is not controlled. What is not controlled is never changed. So at the very, very beginning, like many founders like think that this is obviously not as important. And yes, it is true that they shouldn't be doing it, but that doesn't mean that it's not important. They should be consuming metrics, and they should be have like a report from day one to make decisions based on that. So we think it's pretty important. So let's see how to build them, what they should include, and how to read them as well. So now is where we go to Excel, and we are going to go to Excel for a very long time in this webinar today. So we are showing here 2 examples of 2 different reportings. At the beginning, we designed this webinar for just one. But we thought that it would add a lot of value if we showed 2 different examples. And in fact, this already proves one of the first points that I want to make. We are going to show you like a very standard structure, and like as you will see, like both of them really look alike already from the cover and from the tabs they have. But you should also personalize each reporting. It's not the same if you do the reporting for I don't know, for Apple, and if you do the reporting for Netflix. There are, some things will be similar, of course, and in the three of them, you will need to check the P&L, the cash flow, and the KPIs, fine. But of course, then there may be subtleties that apply to one model and not the other. So just to introduce the two. So Acme, of course, by the way, this is based on real clients that we have, but we sanitize them. Okay, so I created two fake companies. One is Acme, like in the cartoons. The other one is Flancrest Enterprise. This is a little more subtle reference that is actually in The Simpsons, the Flancrest Enterprises. But obviously fake companies, but based on real companies that I'll give you some information about, such that you can understand the messages and how to read them. By the way, Danny just shared in the chat the links to our YouTube profile and the information about this webinar series. So Acme, it's a B2B SaaS, but it sells huge contracts. We can already see like one piece of information is the average or the annual contract value on average is 103,000 euros, which is pretty big contract. On the other hand, Flancrest, being a SaaS as well, it has like an annual contract value of just 1,000 euros. As you see, one is 100 times bigger than the other. And we will see that this creates many differences. By the way, obviously, like we sanitized all the figures, and on top of that, like I chose a very own report delivery. So we will analyze this. You see that also more differences. Acme has three companies. So it's a parent company and two subsidiaries. While Flancrest is only one company. We will see that this will like have some conclusions. It will create some difference afterwards. And also another difference is that Flancrest has several business lines. It's not just SaaS B2B. They also have services, consulting, and B2C. While Acme like has MRR, but like basically SaaS services are like not really important, and the setup is associated with new MRR. We will see like what these link adjustments mean later. So first thing, before getting to specifics, you see that you should pay attention to the structure of the tabs. By the way, something really important already is that, of course, this is not the only way to do our reporting, and different CFOs may have like different styles, and that's completely fine. But of course, we think that we meet all the best practices with this kind of standard model. So first of all, you will notice that there are two sections very well differentiated in both: reporting and forecast. The reporting is what has happened up to date in the year to date, essentially. What has happened. And in the forecast is from now on. So it is crucial that both things are connected in the same file. Well, first of all, it is crucial to include a forecast in a startup, because in a startup you have huge uncertainty. So you're forecasting something in January, for example, here the light columns are the budget, but then things keep happening like that, like create that after your business plan was done in January, then maybe by July you already know like many more things in the future, so you need to correct your hypothesis. So you should always like count on building forecast and update it monthly, not just like every now and then exercise. And also you need to have the forecast, and both sections need to have the very same structure if possible, such that one speaks to the other very well. This is actually very important. If you don't connect the two exercises, then you will only see the differences in the P&L, for example, but not in the business drivers. So if you connect everything, and if you calculate the forecast the same way you report in the company, you will see like, okay, we are not meeting the revenue targets because we are having more churn, for example. Because when you modeled it back in the day, And when you model for the future, you need to have like, what was our churn? What do we expect from now on? If you don't connect both exercises, we see many companies in which the forecast has nothing to do with the reporting, and it is obvious that it will not happen because it cannot be the same company, to put it that way. So we always connect them and have the same structure. Something that is also important is that, by the way, we are only showing you output tabs. This was like a little of the elephant in the room. We are showing only output tabs. Of course, here they are hidden many tabs that calculate the figures over here, and you see that it's connected and stuff like that. So this output tab should be like the cover and at the very beginning, and then you have some others. Something important again before going to specifics, but I want to give a general overview at the beginning. Everything, as you can see, is divided in three things: P&L, cash flow, and KPIs. For us, this is something that we keep saying all the time, even in sales calls. We say all the time, like, we track P&L, cash flow, and KPIs. For us, it has become like a very common sentence to say it that way. Why is that? Many times people, when they are thinking of like projecting their company and reporting on how their company is doing, they think that they project the P&L and that's it, or they report on the P&L and that's it. The P&L, as probably you all know, is like a revenue minus all the costs of the company. And of course, that is crucial, and it's probably the most important. But this is why this webinar is called Startup Reporting and not any company reporting. That is that, first of all, cash flow is incredibly important in any startup because, startups, as probably you all know, keep raising money, keep raising funds. So if they do that, it's because they are going to spend it. So like they are always like, losing cash, and that's fine, and that's deliberate. But yeah. So you always need to keep an eye on the cash. Then also on the KPIs, also something that is crucial in any startup is to let me open this. There's like the color coding. I don't know why the color coding is failing the other one. So so in this one, for example, you in a startup, the unit economics and the KPIs and the business drivers are many times way more important than the P&L. Meaning that we will see later that if I have an LTV over CAC that is like a very positive number, a very good number, then this means a lot to the investor. So you cannot have a reporting that is like, wonderful in financials, in like compliance financials, a balance sheet, a P&L, cash flow statement, all this stuff. But it misses crucial information on unit economics. Or in the case of a SaaS, that we will have another webinar specifically on SaaS, that it doesn't have like the figure of upselling or the cohorts that we will see, stuff like that. So this is like why it's crucial, and we will keep analyzing P&L, cash flow, and KPIs. So, and another important thing is that for everything in the reporting side, we compare it always to the business plan. If you don't compare numbers, you're like, did we expect this? Are we doing better or less than expected? To read all these figures is like, okay, how are we doing? And this is why we always put, well, the 3 last months, simply because we don't want the file to be too annoying as here. And the 3 last months, how the business plan, the budget at the beginning of the year compares with what happened, like the actual figure that we were expecting, the difference in absolute number and the different percentage-wise. And this is because you need something to compare with, and this is actually crucial. Are we meeting our targets or we are? And this, we do it month by month against business plan, difference in percentage, and also year to date. Because obviously, like we are now starting June, so you would like to see like up to May, what happened. And like some months may have been better than others, but like, okay, overall, we're missing our revenue target here, like by 15%, for example. This is the revenue figure year to date, a difference percentage of the year, 15%. Color coding helps, obviously. Again, I don't know why in the other file is not working, but well, whatever. These files are usually pretty heavy. Something else that you may have noticed that is not the exact same between the two. Okay, I'm claiming that the structure is the same, but we see here pipeline, while we see here cohorts. Why is that? It's again because standards are amazing, and they help us understand things and like model many different models, whatever. But you need to personalize it enough for each client to be meaningful. So Acme, we said that they have huge contracts of 100,000 euros each by now, 100,000 euros per annum per year. So here it is obviously they sell very few new clients per month. As we see here, for example, you see in April they did 1 new account, in May 0, in June 1, and stuff. So it is not the same if you tell me, I've sold 0, but I have like 5 contracts about to sign, that it will be the end of the world if like 4 of them don't sign. It's not the same than that tell me like no one else is like even interested, or we are only having like cold calls right now. The message is crucial, and also you need to work ahead of your metrics. You want to have like the metrics that tell you about the future and not the other way around. So in this client, it is crucial that we say that we have 30 opportunities in qualification phase for a total of 900,000 euros, 14 for 1 million, and 2 of them you already made a proposal for 600K in total, and no one is negotiating. So you could expect, depending on the sales cycle of this client, of this startup, that maybe in a couple of months, one of these guys sign. And that may be good or bad news compared to the business. If with everything we have on pipeline, if we sold absolutely everything, it will be like 2.9 million. But of course, we expect that many things will not sign. So if we took the average, we would expect that 850,000 will be sold. In the case of Flancrest, it is the opposite. Flancrest sells contracts that are 100 euros per year, but as you see, they sell 70 new accounts per month, 85 new accounts per month. As you can see, they are very different businesses. Both of them are SaaS, but obviously you cannot use everything like like every single metric that is the same in both cases, or like the same mindset for both of them. So something here that is important is the cohorts. The cohorts, we will have a whole webinar on them, and we will cover a little by the end of the webinar, probably, if we have time. But they show us the evolution of like the accounts that we captured, for example, in June 2020. With time, they start paying us more than when they were paying us at the beginning, for example. And you want to see here like the effect of any change of strategy, the effect of like of any seasonality and stuff like that. So that if you are acquiring 4 clients per year, this will look very ugly and very empty. If you're acquiring 80 clients per month, this is actually very significant. So, and last difference, I promise before we go into a little more detail in the tabs, it is that here we see that in both of them we have some splits on the metrics. So, for example, here we have KPIs in Spain, and KPIs in the rest of the world. Here we have like P&L global, and then P&L for headquarters, for EMEA, APAC, and that's it. Yeah, the KPIs also like for EMEA and APAC. So these splits, this is very important, don't necessarily mean the split on companies or like subsidiaries or whatever. We said that in Flancrest it is just one company, but they want to see different metrics, or they want to analyze separately the business in Spain and the business in the rest of the world. Why is that? Because the business in Spain is very mature. They have 2,000 accounts. The business in the rest of the world is 176 accounts. So this happens very often. You start in your own country and then afterwards you expand, like we did. So here, for example, like the new accounts are like 117 euros, and here the new accounts are 44 euros. So if you took the average, you do have an average here that may make sense and everything's fine. But then this gives you like really important information on like, okay, they are not the same. Both markets are like very different. We are meeting the objectives in one of them, but not in the other, and information. In fact, yeah, we're missing by 10% in one case and by 22% in the other. Stuff like that. So, and on the other hand, in Acme, their last funding round, they raised it essentially to open the business in APAC, in Asia Pacific. So we see, and again, we will get to understand all these numbers better, but by now, trust me, this figure is the adjusted EBITDA margin. So it's EMEA as a business unit, again, not necessarily related with the company that like carries the cost and the revenue. As a business unit, EMEA is being profitable. On the other hand, Asia Pacific is not. We're investing a lot of money on it, and it's still not profitable, and that makes sense. But we want to know that if we take just like the general average, we cannot distinguish here what's happening with EMEA versus what's happening in APAC. And again, APAC was the focus of that funding. So, also, by the way, for like when the company wants to be profitable, then you like the different business units should support the central expense. So we usually put a tab on headquarters, meaning like the tech team and the admin team, some central cost that will need to be supported by the different regions. So this means that, imagine out of startups, a daily example, Starbucks. A Starbucks, needs to sell enough coffee such that the gross margin of each coffee pays for the salaries and the rent and stuff of a single place. Then that cafeteria needs to make enough profit such that they can pay the country offices. Each country needs to make enough profit on top to cover like the cost of the people in headquarters in Seattle. And those guys still like, the company needs to make enough money such that they can pay out dividends. So this is like, let's track in the analogy, like the different Starbucks shops that we have, EMEA and I think on general comments, this is more or less what I wanted to say. Again, feel free to stop me at any time. Again, like unmute, raise hand, chat, whatever. I have the chat open right here in case you're more shy. So let's go page by page. We always put like a cover page, and to be honest, I'm not especially proud of it because I think I read better numbers than charts, but most of the people don't. So, or like our clients don't, and prefer to see charts, and I think we're lucky on that. On the cover, I'm not gonna stop too much because then it may be very, very different for each company, especially for each business model. So, in this case, it's a SaaS company. For example, we want to track the MRR, we want to track the number of accounts, the annual contract value, adjusted EBITDA. We will talk about the adjusted afterwards, and the cash that we have in hand. I would say that these figures are the most important for a SaaS business in general, but obviously this is arguable, or that we will see that they are not even the same in this case. For Acme, it also depends on the startup in particular. We wrote ARR, we will see that it's only 12 times the MRR, number of accounts, ACV, but here they have closed new ACV, which means like ACV that I've already signed, but I still haven't invoiced. For a company that has very few contracts, this is a very important figure. Adjusted EBITDA, cash in the period, runway, when we think that we would run out of cash. Thank God it didn't happen in real life, by the way. They're still fine and healthy. And how much they're burning. So like with these three figures, they can make some calculations to come. And a couple of charts on the evolution of the MRR and the changes in MRR. This chart is like new MRR, upsell MRR, reactivation MRR, downsell MRR, and churn MRR. Again, I'm not gonna stop too much here. We have like this kind of like basic model for SaaS. We also here, for example, that it's a more advanced version of our reporting. We compare it versus budget and month over month already in the cover, or we put the burn here. Again, this is more on visuals, which I admit we are not like real experts, but this is more on visuals and on communication with the final stakeholder. Then on P&L, definitely I'm gonna stop here. So we see that this company has several business lines. So I always say that in a good way, our reporting is not very financial. Obviously we are in charge of that. Obviously, the company has a formal P&L and a formal balance sheet and a formal cash flow statement. But we think here about the business. These are like what is called the management accounts. So obviously the information need to translate to from one to the other. I'll speak later about that. But you see, like here, it's way easier, in my opinion, to see like how the different business lines are behaving. Or SaaS B2B has like this MRR, this cost of sales, and this gross margin. And personal cost is divided by cost center and sub-cost center, and has some additional information here that we will cover. Operating cost in terms that we can understand, and we'll see later the other results. So this is supposed to make sense for the business. So if you tell me only the financial, the very financial reporting, like the compliant reporting, only like the figures that I'm like not highlighting would show up. So actually you would lose a lot of information that is really needed for the company. You could only see like the ones that I left in white. And obviously you have way less information than what you need. And we will see it like in many places. So for revenue and cost of sales, we try to split it if it makes sense for the company, and we will see actually both examples, in business lines. Flycrest has SaaS B2B, purely MRR, recurrent, whatever. They have services associated to it, not always setup, it's sometimes like some hardware, stuff like that. Consulting, which is projects, purely. This is more common than it seems for SaaS business, because many times they do consulting projects that in time they will incorporate to the product, for example. And also they have like a B2C business line that, as you see, is very small. Here already you can see that, of course, the most important is the SaaS B2B, but the other ones, like how do they compare? For example, 53 versus 170. So this is like 3/4 of it, a little less than 3/4, I think. And again, you have here like the year to date, they have already done 1 million on SaaS B2B, and the others are over here. Hidden, you have the rest of the months, but you don't care. So, and for each of them, you want to see like what are the costs directly associated to it. The costs that are directly associated to it is not always something like that is black or white, but rather, there may be some difference. My advice would be to be conservative, if anything. If there's an expense that if you had 10 times more client, the expense would be like 7 times more or more, then it's a direct cost. And again, there could be like arguments on this. So, and here, like with both numbers, you simply see like what is the gross margin, the net revenue. Well, net revenue and gross margin, more or less, you can like change them. Let's say net revenue, not to confuse them with what we put here, gross margin. So you see, like a business line may have a lot of revenue that if it has a lot of cost associated to it, it is not that profitable. So here what we see is that this business line, for example, it gives us 147,000 when our revenue is 178,000. So here, percentage-wise, let's say like year to date, that it will be a more stable figure. This is not only the biggest, but also the most profitable business line in terms of gross margin. Services is not that profitable. This happens very often, and consulting the same. And the B2C, we don't like assign any cost associated to it. I usually don't like this of like not writing any cost associated as cost of sales. In this case, to be honest, I forgot. I forgot like why exactly. If you are probably like, if you do it ideal and if you spend like, time on making sure that it's going well, probably you should like split some costs associated to cost of sales, that it may be servers and stuff like that, to B2C. But anyway, it's a secondary business line, so I'm not like, it's not the end of the world in my opinion. Here you can track that, for example, conclusions that we may infer. B2C is going like pretty bad. Like we have, our revenues are 60% less than what we expected. And the SaaS B2B is 15% less. As it is the biggest, this one is the heaviest also like it's partially compensated by this too. So this we will already see some conclusions. However, the cost of sales, what we would expect if everything went right, is that it also decreases as much as the net revenue. And it doesn't, we're actually spending more. And that's why our net revenue is, like even worse than the 15% of that. And the gross margin, therefore, is also worse than we wanted to do. On a SaaS, something below 80% is, like an alarm. And the SaaS part here is like 80, 84. It's a very complex software, so it makes sense that it's around 84. In the other example, what is something that many times sounds tricky at the beginning. So you know that the company has the figure of the MRR. We will cover it in another webinar, which is basically like monthly recurrent revenue, and it tracks like how much our clients are paying us in total at a given moment. However, that doesn't always match the accounting figure. The accounting figure may be a little different because currency exchange, invoice correction, stuff like that. So we usually track the MRR as the business figure, and we compensate it with some adjustments. But again, like accounting-wise, it makes sense that like some of these different show. And something very important here, very, very important. For all this, the input must be accounting. Many times our clients think that they know their operating cost top of mind or their personal cost top of mind. Yeah, we're spending around 60,000 on personal cost and operating cost like 15,000. And many times you tell them like, no, you're spending 25,000 a month in operating cost. I tell you that's not possible. You're like, look at the accounting. And then they are like, true. In this month, we also spend this. True. This invoice I forgot. So this is why all this should come from accounting as the ultimate source of truth. Then we split it in different cost centers, and usually we do it like item by item. But this should come from accounting, and therefore the revenue should match the accounting year to date, and the EBITDA should match accounting year to date because it comes from accounting. Then, of course, everything is split in different cost centers. In the meantime, cost centers or revenue centers and all this kind of cooking that we do and distribution that we do. So here, for example, again, in this case, it's not like different business lines. In reality, it's different items within the same business line. And that's why we only track one net revenue. And it doesn't make sense to say like the net revenue in each of these. And by the way, servers, which is infrastructure, is the only thing that really affects. So in this case, the net revenue is very high. Actually, yeah, this happened, by the way, because they had an agreement with Amazon Web Services. Otherwise, it's absolutely unbelievable that they have this gross margin. And that happens, by the way. Then there's another section that is very, very important. Actually, I'll try to speed up a bit, such that I'm sure that we have time for the KPIs as well. Personal cost is the most important section, in my opinion, because it contains the biggest costs by far. Usually, personal costs are 80% of the total fixed costs. The total fixed cost being operating plus personal cost. So, among all the costs that are not variable of the company, 80% of it, usually in a startup, is staff. So, many times, and this is, in my opinion, a mortal sin, if you download a template online, especially for an SME, not a startup, they will show you many times like that expenses are just personnel, marketing, and SG&A, sales general admin. And in my opinion, that's a mortal sin in a startup. If this is your biggest expense by far, and you're investing in that technology, and you're investing in sales and marketing, then you cannot just say like, I'm spending 1.4 million in the year. If you ask for a funding round of 2 million or 2.5 million in the past, and you're saying that, 1.4 million is in stuff, it's crazy because you need to know like what in particular you're spending on. So here, for example, we have sales, and within sales, we split it, people that are dedicated to Spain and the rest of the world. Marketing, tech, which is subdivided in 4 cost centers, corporate, which is subdivided in 4 cost centers. And then in each of them, you can track the differences that you expect in both absolute value and relative. So, for example, in this marketing, we're spending more than we expected. Maybe, is that we hired a more senior person than we thought, or we hired someone in May rather than in August that we were expecting. In tech, however, we're being slower. We're not hiring at the same pace that we thought we would. If you say year to date, it's more or less the same picture. We're spending 11%. By the way, this is super common in startups. They usually tend to overestimate the revenue and overestimate the spending. So many of our clients have like a minus 20% in revenue and a minus 20% in costs, something like that. This is super common. Because hiring fast is not as easy, or because people leave, so therefore, like, for some months you have a gap, stuff like that. By the way, usually I put here a personalized example, but our very basic cost centers for the people, like for startups, to distribute stuff, is operations, sales, marketing, tech, R&D, call it whatever, and admin. With these 5 and sub-cost centers on these 5 or something similar, you should probably be fine. So just marketing and SG&A, I think it's a big mistake. And this is like to operate the company, to make it grow, and to and the product you are building and the administration. So I think this is a very reasonable split. Operating costs, we do exactly the same. We distribute them from accounting to the different cost centers, and we compare with what we need. Here we have the fixed costs, personnel and operating, and then we get to adjusted EBITDA. And you're probably wondering why the hell we need adjusted EBITDA. The adjusted EBITDA rather than the formal EBITDA, because in accounting you will say this EBITDA. So why did we split, and what the hell are these things in between? Here is because there are some things that are completely exceptional in a business. If you raise a funding round, you're going to have a huge invoice from the lawyers. Huge, you cannot imagine. So that if that happens in June, I don't want to say like, wow, June was a terrible month. And it would like be misleading to say, how much are we more or less spending every month, whatever. This is misleading. So like for very exceptional things, accounting adjustments, defaults from clients, stuff like that, then we use these like other revenue, other costs. Also, if you get a grant, for example, that would be revenue technically, but you don't want to say, hey, your revenue was amazing, but rather you put it down here. You check that the EBITDA in accounting and in your management accounts are the same, but you split like things that are not directly on the revenue. So that's why we focus constantly on the adjusted EBITDA with our clients, not so much in the formal EBITDA. This is on P&L. Again, we could be talking hours about this, but I think we can move on. But if you guys have any question, please feel free to them. And in terms of cash flow, first of all, never use formal cash flow statement. A formal cash flow statement is useful for a traded company, but definitely not for a startup. It just doesn't provide you actionable information, which is our main goal. So what we have here is every month we have like some cash at the beginning of the month that is equal, obviously, to the cash position at the end of the previous month. And then some cash flow related to the operations of the company, essentially the mirror from what we just saw. So revenue transforms in collection, personal cost transforms in salaries, social security, retentions and stuff. And the operating cost and the cost of sales and capex, which we haven't covered, but well, investments in capex, leave the company. So here we always take a rolling average of at least 3 months to make sure, like, to answer the question, what is your cash burn? Because like, in July, for example, in Spain, you have taxes, you have to pay retentions. In some other countries it's monthly, but in many of them it's quarterly. Or still, like, like just a given month, maybe an exception. And if you take an average, then you are more sure of what's happening. And then we separate the financial cash flow. If you get a funding round, then it's like, fine. If you get a loan, all right. But I don't want to say, oh, I'm burning way less because of that. And by the way, this is like a little outdated. We have improved many things on our reporting by now. Like, for example, tax, we split the ones that are operational or the ones that are non-recurrent. And obviously, if you are paying debt, okay, it's fine, but that answers to how you finance yourself, not so much on your operations. Hector is asking on the chat, how do you make sure everything is matching? Do you have hidden checks? Yes, actually, I mean, I'll show you here, for example, I think we do. Here, a check. But for the P&L, what we usually do is in our process of doing it, like we have a checkbox to check, like, is a bit the same than in accounting, yes or no. Or we also, like, in the input tabs that I'm not showing, you have only like a data validation such that you have to pick from a list the cost center. So the cost center would always be in one of these. So therefore you make sure that you are not forgetting it. But yes, many of these kind of checks, that's like good practices of Excel modeling, are definitely needed. So you end up with a total cash flow, and you end up then with a cash position at the end of the period. In this client, for example, in Flancrest, we have also an available credit line. So we use the figure of a cash available. This is again particular from this client and not from the other, not from Acme, that we don't have, I think, like a credit line. Also, by the way, here in Acme, we also calculated company by company in order to do the checks. Because we remember that we were having 3 companies in Acme's group. So also another little figure here is the estimated runway. Runway is when are we going to run out of cash? And these are 2 ways to calculate it, like a quick one and a slow one. The quick one is to say, how much are we burning right now? And it's including everything. And then it's like 100,000 per month. And we have available, well, in this case, I guess we were conservative, like available cash. You have 780,000. So you would run out in about 8 months, which from July of 21 is March 2022. This is like just a simple division. That's it. Obviously, in the forecast, you will have, like, according to everything that you have, when do you expect to run out of cash? In fact, actually, we're counting here with a funding round. If we didn't, it would be April 22. So actually, it's pretty similar in this case, but it's not always the case. So then, again, this can be more complicated. You may split here like public funding from non-public funding, private funding round, whatever, dividends, if any. So, you can split more things. Okay, so Romina is asking, do you prefer calculating cash flow with direct method instead of indirect for management accounts? Yes, at least for management accounts of a startup. So here we do the exact same thing. We take from the general ledger every single cash move, and we assign it to one of these categories. Actually, it's easier than it seems, and actually we automated part of the process. So yeah, we prefer this method. The indirect method in a startup, like even the balance sheet of a startup, is not that important per year. By the way, it's probably the elephant in the room that I haven't even mentioned the balance sheet. Why? Because in a startup, it's usually like not the most crucial thing. I like to read them, but it's like unit economics and KPIs are going to give you this information. Cash flow is crucial, and you're concerned with cash flow in any case. P&L is going to give you this information, and balance sheet will give you this information. The more the better, yes. But therefore, like, to calculate cash following the indirect method from the balance sheet, I think you really it wouldn't like add so much value to the management. Also, very interesting question from Victor. And by the way, I love that there are questions, even if we have to rush afterwards. Which ERP do you recommend? It is hard to find one that is big enough that can gather all this data, but small enough and user-friendly for a small startup. I couldn't agree more. This conversation could trigger hours, but I will just say like my own personal summary. First of all, as an ERP that you need to, to do formal accounting and do taxes and upload the invoices to and stuff like that, pure reporting and pure financial accounts, I would recommend Holded. Holded, I really like it. It works very well, intuitive. It's actually a startup invested by Nauta that was very successful. And in my opinion, I really like it. They are all similar, in my opinion, in that sense, but they're fine. But then the hard part is the forecast in an ERP. Obviously, if you're a company as big as Apple, you're not using Excel for forecasting. You're using a crazy good and expensive tool. As you were saying, that is big enough that can gather all this data. And yes, the implementation of that probably took literally years, and I'm sure it was very big. But if you're a very small company, I agree, there's no software, and we have really researched on this, and this is my humble opinion. There is no software that can be as powerful as Excel many times needs to be, because you need to take into account, yeah, but with this particular client, I want to model this in a different way. So you end up like doing things cell by cell. I think it's not worth it to have like a very fancy software for a small startup. Also, you will keep changing your business model all the time, changing your processes all the time, as it should be. So it's not worth it to have anything beyond Excel, in my opinion, for management accounts of a small startup or for anything related to forecast. So, for example, Abacum solves that problem, but they say that they prefer companies that are beyond 200 to 150 employees. So, for a small startup, I'd rather use Excel beyond financial accounts and hold it up to financial accounts. But again, this could be like a very long topic. And then on KPIs. On KPIs, I'm not gonna go too much like in detail again, like because this depends on the business model. So, for example, this is a SaaS model, and we will have a webinar on SaaS. And here in a SaaS business, you want to show not only the MRR, the monthly recurring revenue, and not only the number of active accounts that you have, but rather, the split of it. It's not the same that you grew from this month to this month because you lost 100,000 euros, but you gained 105, or if you lost €0 and you gained 5,000 euros. By the way, here is one of these checks that we were saying before. So this split is crucial. This split is what we use to model the startup, and actually what we keep using to model the startup in the future. And this is like why figures, if figures in the past don't talk to figures in the future, especially percentage-wise here, I would not trust this forecast. But here you can say like, okay, it's more or less aligned. So these KPIs are crucial. And again, for an investor or for the CEO, this should be more important than almost anything else. And especially, for example, the net churn. All these are specific metrics for your business model that you want to track, and you want to see how far you got from what you expect. You have less accounts that are bringing you less MRR, because on average they are 5% smaller than what you think. Also, this looks very similar in both SaaS businesses that we have here, but it's essentially the same. But for example, here the pipeline is crucial, and here the one shot, which is called that the non-recurrent revenue, is important, and this is why they are different. And here, in this case, like we always have to calculate lifetime value and CAC. And this client is a little more complicated because they acquire partners that resell their product, stuff like that. I'm not going to go into it. But in the very first webinar, we covered the unit economic metrics that every business plan and every reporting, again, same language, should have. So in both of them, we're calculating LTV over CAC, and we want to see if the ratios are good and healthy and reasonable and all that stuff. We also like to include the headcount because obviously, again, if 80% of our cost is staff, then we better know where they are. So we see here that there are like 13 people in product, 14 people in sales. This is very often the case that the product and on one hand, like the tech team, and on the other one, the growth team are similar in size. Well, including marketing is like 19 to 30, a little more on sales. But and here, I'm a little surprised, like corporate seems big for this kind of company. Again, in the other one, we have our classic cost centers, 16 people, 9 versus 6 in R&D, which means that they are like investing more heavily on the product, and only 1 in admin. By the way, you maybe are surprised by this decimal points, parts of people. And this is the case because someone can be working part-time and the company may want to count him as like 0.3, or someone may be split in different cost centers that would add up to one person. But for example, here we have a 4.5 and the other half somewhere else. Something like that. That is more particular like company to company. But again, I want to keep the important messages from all this, which is, forecast and reporting need to talk to each other. Reporting need to be compared to the business plan in absolutely everything. You need to do P&L, cash flow, and KPIs split, like with the splits that make sense. In this case, for example, was the regions, and in the other one, headquarters and the different regions. That also track like your kind of unit economics. You have to do like standard is fine, but always you need to personalize it, and the more personal the better. And again, that's why we had cohorts in one and pipeline in the other. Also, more practical stuff. Yeah, everything from accounting, which is the ultimate source of truth, but split in cost centers or in let's call it cost centers as well, in a cash and P&L, such that it provides us a business information. And the like below adjusted EBITDA, very few things, but that are like accounting. They are not truly about the company's performance. And those are more or less the messages I wanted to convey. Of course, again, huge disclaimer. Anyone like may have their different style. In terms of forecast, I'm not gonna go. I think like in this case we hadn't put still the personal cost, whatever. But something I just want to stress, obviously, there's a whole new part on modeling and on how to model the future. That of course is not easy, and of course it depends on each company, and it depends on that even more on styles. But the message I want to convey is that the future should follow the past, such that it's easier to see if we are like doing something wrong, or that we will be able to track the business drivers month to month, and that our hypothesis may be making sense or not making sense. So it doesn't mean that it needs to follow like to the cent, that would be stupid. It's like the future is not a perfect projection of the present, but it should certainly communicate with the present. So this is why we have like many KPIs. Of course, by the way, we would always share as CFOs these figures with comments, like take a look here, what's out here, you are missing the targets here, and also spending more in cost of sales, which is weird. You shouldn't be spending that much in cost of sales, so you are not meeting your targets in revenue, and many insights that we could try to provide, especially on KPIs and on cohorts. So again, if anyone wants the presentation, I prefer not to follow it deliberately. As you can see, it like more or less summarize what I just said, but it may be easier as a document to have, or as a document to share with other people. So both of them, I'll just write my email here. If you want them, the Excel files or this presentation, please send me an email to jaime@tscfo.com. I just wrote it in the chat. The reporting files obviously would go pasted as values and with like without the hidden pages. That's a little bit of our recipe, so it would be a little weird to share it. Any question, whatever? More 1 minute short, but I would be fine like extending it a couple of minutes if needed. Oh, perfect. So again, we will share this webinar in YouTube, so in case you want to revisit it again. Also, feel free to ask me for the materials. And next week we are having a webinar moving on a little to finance, pure finance, and not so much on documents, which is a general review of the startup main business models, their KPIs, their specifics, their subtleties, and all that. So it will be at 3 p.m. CET, Central Europe time, next Thursday, and we will have other 4 beyond then until July. So well, thank you very much again for connecting. I hope it was useful, and let's keep in touch and see you next Thursday then. Goodbye to everyone.